Look at the cash in your wallet, or the digital balance in your bank account. If you live anywhere outside of the United States, your local currency is constantly fighting a losing battle against one dominant force, the US dollar. For the past few years, the headlines have been screaming the exact same warning: the dollar is collapsing. China and Russia are destroying the greenback. De-dollarization is here, and your savings are about to be wiped out. It sounds terrifying. It makes for great clickbait, and it easily goes viral on social media. But if you are making actual financial decisions based on these headlines, you are falling for a massive economic illusion. Welcome to the reality of the global monetary system. While the media hypes up the death of the dollar, the actual data shows the exact opposite. We aren't moving away from the dollar, the world is actually more dependent on it than ever before. Understanding this illusion is the difference between protecting your wealth and throwing it away on speculative traps. To understand why the dollar isn't going anywhere anytime soon, we have to look at how the global financial plumbing actually works. It all comes down to a concept called the network effect. Think of the US dollar like a massive social media platform. Why do you use the most popular social media apps? Because that is where all your friends are. It doesn't matter if a new app comes along with better features, if none of your contacts use it, the app is useless to you. The dollar works the exact same way in global trade. When Brazil wants to buy oil from Saudi Arabia, or when India wants to buy microchips from Taiwan, they don't use their local currencies. They convert their money into US dollars to complete the transaction. Why? Because the dollar is highly liquid, universally accepted, and backed by the largest capital markets in human history. Let's look at the actual numbers to pierce through the media hype. According to the Bank for International Settlements, the US dollar is involved in nearly 90% of all foreign exchange transactions globally. Furthermore, global central banks hold over 58% of their foreign exchange reserves in dollars. Compare that to the closest competitor pushing the de-dollarization narrative, the Chinese Yuan. Despite China being the world's second-largest economy, the yuan accounts for less than 3% of global trade settlements and foreign reserves. Why is the gap so massive? Because to become a global reserve currency, a country must have open capital markets. Investors need to know they can move millions of dollars in and out of a country at a moment's notice without government interference. The US allows this, China strictly controls and restricts capital flight, so, when you see headlines about countries trading in alternative currencies, it is usually a political headline, not an economic reality. It is a slow, inefficient process that represents a tiny fraction of global commerce. If you build your wealth strategy around the imminent collapse of the dollar, you are playing a dangerous game. You might be tempted to dump stable assets and panic buy unproven alternative assets, gold, or volatile foreign currencies, leaving your portfolio exposed to massive inflation and volatility. The smart wealth play isn't to bet on a sudden global collapse. It is to understand how to navigate the system we actually have. To protect and grow your wealth using this reality, you need to execute 3 strategic moves. First, secure your core asset base. Ensure that a significant portion of your long-term investment portfolio is held in dollar-denominated, productive assets. This includes broad market US index funds, high-quality equities, or short-term US Treasury bonds. Even if you live outside the US, exposure to the dollar protects your purchasing power from local currency devaluation. Second, filter out macro-alarmism. When you read a financial headline, always look for the underlying data. Separate political statements from actual trade volume. If a country announces a new trade agreement in a local currency, look at the actual dollar value of that trade. Most of the time, it is a drop in the bucket compared to global dollar clearing systems. Third, hedge intelligently, don't panic hedge. It is perfectly healthy to hold alternative assets like gold or digital currencies as a small percentage of your portfolio to protect against local systemic shocks. However, these should be treated as insurance policies, not the core engine of your wealth creation. Never sell your cash-flowing, productive investments to buy non-productive insurance out of fear. The headlines will keep trying to scare you because fear generates clicks. But wealth isn't built on fear, it is built on structural reality. the global dollar system is deeply entrenched, and the infrastructure holding it up will take decades to shift, if it ever does. Stop waiting for a monetary apocalypse that isn't coming. Focus on the data, invest in productive assets, and let the network effect work for you. To help you position your portfolio correctly for long-term stability, always balance your investment decisions based on global economic realities and proven assets management strategies with sound, time-tested financial foundations. If you found this video valuable, hit the subscribe button, turn on notifications, like, follow and share this with a friend who is interested or worried about the future of the financial system. Stay smart, stay wealthy, and we'll see you in the next video.